Hello class, welcome to week 1 of financial management. So what is finance? Finance can be defined as the science and art of managing money. At the personal level, it's concerned with decisions like how much of your money that you spend, how much you save, and how much you invest. In a business context, finance involves how firms raise money, how they invest money in an attempt to earn a profit, and how they decide whether to reinvest profits in the business or distribute them back to investors. There are 3 types of legal forms of business organizations. The sole proprietor, this is a business that's owned by one person and operated for profit. Partnership is a business owned by 2 or more people and operated for profit. A corporation is an entity that is created by state law. Corporations have the legal powers of an individual in that they can sue and be sued, they can make and be party to contracts, and they can acquire property in their own name. There are strengths and weaknesses to each type of businesses, so I recommend that you review all of these to familiarize yourself with the different advantages and disadvantages of the various business types. There are also variations of corporations and partnerships that can be incorporated at the state level. One of the main questions that's typically asked in the beginning of a financial management class is, what is the goal of the financial manager? And that is to maximize shareholder wealth. So the financial manager will look at a decision and they will weigh the return and the risk and ask if it will increase the share price. If it will not, they will reject, and if it will, they will accept. Stakeholders, these are groups of people like employees, customers, suppliers. They're not shareholders, but they have a stake in the business. And so businesses typically try to avoid any action that would harm the stakeholders because this would not bring good publicity and could ultimately lower the share price, which goes against the main goal of the financial manager. Ethics, these are standards of conduct or moral judgment that apply to persons that are engaged in business. Violation of these standards can be things like creative accounting, earnings management, excessive executive compensation, bribery, kickbacks, and the publicity from these negative ethical actions can have a bad impact on the firm and on the shareholder price, which goes against the main goal, which is maximizing the shareholder price. Finance is related to economics very closely. Managers have to understand the economic framework and be alert to consequences of varying levels of economic activity and changes in economic policy. They also need to be able to use economic theories to help guide them in their business decisions. Also, finance is related to accounting. So small firms, accountants often carry out the finance functions, and in large firms, the financial analyst often helps to gather and compile accounting information. One of the main differences is that accountants usually use the accrual method, which is where you're matching your revenue to your expenses. With finance, the focus is on cash flow. Governance and agency. So in 2002, the Sarbanes-Oxley Act was put into law. This established an oversight board to help monitor companies, public companies. It tightened their audit regulations, toughened penalties against executives who commit corporate fraud. It strengthened accounting disclosure requirements and ethical guidelines for corporate officers. It established a corporate board structure and membership guidelines and guidelines with regard to analyst conflict of interest, because we want our analysts to be not biased, right? We want them to be honest and give an honest disclosure of the company. The principal-agent relationship, this is an arrangement where the agent acts on the behalf of the principal. So, for example, the shareholder of a company is the principal, and they elect management to act on their behalf. Problems can arise when managers put their own personal goals ahead of the goals of the shareholder. Agency costs arise from agency problems that are borne by shareholders and represent the loss of shareholder wealth. In addition to roles played by corporate boards, institutional investors, and government regulations, corporate governance can be strengthened by ensuring the manager's interests are aligned with those of the shareholder. And so a common approach is to structure management compensation so that it conforms and corresponds to firm performance. Incentive plans are management compensation plans that tie management compensation to the share price. And so one example would be granting of stock options. Performance plans tie management compensation to measures like EPS or growth of earnings per share. Performance shares or cash bonuses, these are used as compensation under these plans. So it's just a highlight of what you'll be covering this week. Make sure that you read the assigned reading and complete all of the knowledge path work before you complete any homework or quiz for the week. And good luck, everyone. I'll see you in the discussion.